Asset retirement obligations are another form of operating liabilities. We're going to walk through an example so we get to know what an asset retirement obligation is and how we account for it. First, let's assume we have a gas station that was put into place on January 1st, 2019. Its cost was $500,000. Its useful life was 15 years. There is a cost to dismantle it in 15 years when we're done with its useful life, and we estimate on today that that cost will be $75,000. The discount rate, or sometimes the cost of capital, is provided for us, and that's 10%. The company does straight line depreciation, and we find out 15 years later that the actual cost to dismantle were $77,000. All right, so when we begin, we need to show acquisition of the gas station, and we see journal entry number 1 shows the gas station $500,000, cash $500,000. The next piece is our new piece. It's asset retirement obligation. What we do is we take the present value of that cost to dismantle. So using Excel, I plugged in the numbers 75,000 for future value. Number of periods was 15 and the interest rate was 10%, and I got a present value of 17,954. So that's our obligation. We have to list it on our balance sheet at its present value. So it is our new operating liability. Here's the thing though, that asset retirement obligation is necessary. It's a part of having the gas station. We can't have the gas station without dismantling it at the end. So it's a probable future sacrifice of resources, and it's considered part of the capitalized cost of the gas station. All costs necessary to get it ready for its intended use, that includes the asset retirement obligation. Therefore, we go ahead and debit gas station for the 17,954 and we show the liability. Or you could have done a compound entry where you show the gas station at the combined amount and we show the asset retirement obligation, the cash, all in one journal entry. Either way, we have the gas station now totally listed at $517,954, and now we're going to see how we take care of it during its useful life. There's two major entries that have to be done each year. First, we have to show depreciation expense. Notice that I take the entire capitalized cost of the gas stations, the $517,954, and I divided that by 15, the useful life, and depreciation expense is listed at $34,530. And we show accumulated depreciation increasing by the same amount. The next piece, which is new to us, is recording what's called accretion expense. And basically, we can look at this as time value of money. 1 year has passed since the last time we looked at the asset retirement obligation. We're 1 year closer. So we have to show that we're 14 years out, not 15 years out. One of the ways that we can do this is simply take the beginning ARO, multiply it by the discount rate, and we show the 1,795 as accretion expense. So at the end of the second year, the asset retirement obligation has increased. At the end of 15 years, that asset retirement obligation will be up to its $75,000 amount. So each and every year we do those two journal entries. When it comes to the end of the life, assuming there's been no changes in estimates, we have the disposition of the asset. We're getting rid of the gas station, so we show it leaving by debiting accumulated depreciation for the total amount, and we credit the gas station. So we say goodbye to the gas station and its related accumulated depreciation account. And the final thing we need to do is to show the settlement of the liability. We go ahead and we pay cash of $77,000 to dismantle the gas station. We reduce our liability that we initially had set up of $75,000, and the difference is going to be either a loss or a gain. In this case, we have a loss on the settlement of ARO for $2,000. So notice that's just the difference between what's actual and what was estimated. And we're never going to get it just right, but we record that gain or loss in the period that we dismantle it, and that's all there is to it.